Hello everyone, welcome to the Broadstone Academy. Thanks for dialing in and welcome back if you were with us last week. Hope you had a really good weekend. Nice and sunny here, but pretty freezing in the breeze. My name is Gavin Giles. I head up the advisory team in the Bristol office at Broadstone. I'll be chairing today's session. I'll just give a quick introduction now. It is the same intro as I gave last week to the session, so just in case there's anyone new on the call, so apologies if you've heard it before. Please feel free to zone out just for a minute. This is the 6th of 10 sessions that we're running over a 2-week period, covering all aspects of pension scheme trusteeship. The sessions are primarily aimed at brand new trustees, but we think will be useful for existing trustees as well to have a refresher, and also for company representatives who deal with pensions on a regular basis. We last ran the sessions in November, and the material we are covering is the same, although we do have a new session on pension scams at the end of this week. The sessions aim to cover the indicative syllabus that was published by the pensions regulator alongside its code of practice number 7 on trustee knowledge and understanding. That code of practice can be found on the regulator's website, and we really would encourage all trustees to be familiar with it. Codes of practice are under review at the moment, but we don't expect the substantive points of code of practice number 7 to change at all. And really, it sets out the regulator's guidance to trustees on how they can meet their requirement under the law to have a minimum level of trustee knowledge and understanding when they're undertaking their trustee duties. That was brought in by the Pensions Act 2004, and specifically, trustees must have knowledge and understanding of the law relating to pensions and trusts and the principles relating to the funding of occupational pension schemes and the investment of scheme assets. Trustees must also be conversant with their own scheme documents. If you're a lay trustee, you have a period of grace of 6 months to get up to speed. And if you dial into all of these sessions that we're doing over this 2-week period, that should give you the minimum level of knowledge you need to meet these requirements. However, you can underpin that learning by signing up to the regulator's online trustee toolkit, and we would very much recommend that you do that. It provides modular learning that you can pick up and put down at your leisure. It's updated from time to time, and also acts as a really good audit trail for the learning that you've done. Today's session is on setting investment strategies and builds on our investment session from last week, where we introduced all of the main asset classes that you'd likely to be dealing with a pension scheme. Please feel free to ask questions, just type them in the question box as we go along, and I'll try and find an opportune moment to ask our presenter those questions as we go. Otherwise, there should be time at the end for any that are left over. The final thing to say really is that these sessions are being recorded, so look out for those. We'll make them available at the end of the 2-week period. So otherwise, without further ado, I'll hand over to today's speaker, Nick, to take us through the session. I'm going to make myself disappear and I'll be back at the end. Thank you. Over to you, Nick.
Thanks. Morning, everyone. So my name is Nick Miller. I work in the investment consultancy team in Broadstone in the Bristol office, and I'm also a qualified actuary for my sins as well. So today we'll be talking about setting the investment strategy. In particular, we'll be looking at the following concepts. So first of all, looking at what your duties are as a trustee in setting your investment strategy in terms of being aware of your scheme documents and also pension law and regulation. The next, we'll be looking at setting investment objectives. So these are the high-level details in setting your strategy. Then we look at the actual specifics of the strategy. So in particular, looking at risk and return, and also introducing the concept of diversification. Secondly, we'll be looking at understanding liabilities within the specifics of setting that investment strategy. And that's important in terms of integrated risk management, which is now also being promoted by the pensions regulator. Finally, we'll be looking at things like investment risks, and investment risks can mean several things. So we need to sort of drill down as to what type of risks we need to concern ourselves with and which risks we're happy and willing to take on. And then we'll be looking at the analysis of investment strategies before looking at the next steps. It's important to note, going through this and setting investment strategy, there's no right answer for any particular scheme. It would depend on your circumstances. And once we've set our investment strategy, one of the next steps will be looking at the implementation side, which will be covered in the training session on Wednesday. It's also worth mentioning a lot of these principles primarily relate to defined benefit pension schemes, but they also equally apply to defined contribution schemes, albeit there'll be subtle differences. As Gavin mentioned, please feel free to sort of questions as we go along. If anything's unclear, there'll also be an opportunity at the end. So before I move on to the actual details of the presentation, first of all, it's just worth bearing in mind why setting investment strategy is important. So in the diagram on the slide you can see in front of you, you can see that the order decision-making process first starts with setting your strategic asset allocation. So looking at how much of our assets we want to use in terms of protecting against our funding position or tracking the liabilities of our pension scheme, and how much do we want to generate investment performance. And that will then drill down into what type of asset classes we want to do that work for us, followed by who do we want to appoint to manage the assets on our behalf, if that's applicable, and what style of investment. So you can see from the chart on the screen that in terms of the importance on, particularly in the sort of funding position of our pension scheme, setting the high level investment strategy in terms of the asset allocation and the asset classes we use has significant importance in terms of the financial impact of the scheme, and then the appointment of an investment manager and the style in which they invest our assets has less importance. They're clearly all important, but it's just to make you aware that setting the high level strategy is key in this instance. So we'll start to go through this in more detail. And first we'll cover trustee duty. So this governs how our decisions are made in practice and what we need to have regard to when making those decisions. So first of all, trustee duties. So first of all, we need to make sure that we're acting in accordance with our scheme's governing documentation or trust deed and rules, and in particular, we need to be aware of any exclusions or restrictions that are included within that documentation. Most trust deed and rules give wide scope in terms of setting the investment strategy and the types of asset classes that we use. However, it's worth bearing in mind, occasionally some schemes will have certain restrictions, for example, with regards to self-investment. So this is where you're investing in assets of your sponsoring employer. Similarly, there may be a requirement for you as trustees to consult your employer. So normally it's regarded as best practice, but your rules may actually explicitly state that you have to do that. You also need to make sure that you're investing in the best interest of your members. So historically, that has meant paying benefits as they fall due. And this relates to the fiduciary duty of trustees. However, that's now starting to be refined over recent years, and in particular having regards to environmental, social and governance issues, and in particular what the members' views on those issues are. This can be particularly important if you're running a defined contribution scheme where the input of your members is important. And finally, we need to make sure we're acting impartially, prudently, responsibly and honestly. So effectively investing the money as if it were our own and not being reckless with that money. You also need to make sure or cover any defined contribution or additional voluntary contribution arrangements that you may have either within the scheme or running concurrently with your scheme. They may have different requirements and different needs, and ultimately may need a different set of investment strategies altogether, and defined contribution schemes will be looked at tomorrow in another session. Other aspect is to look at pensions law and investment regulations. So this has primarily come from the Pensions Act in 1995 and clarified with investment regulations in 2005, and in particular it requires you as trustees to take written advice from an authorised person. So this is allowing you as trustees to reflect on your skill set as a trustee board and acknowledging where there are gaps in that skill set, i.e. if there isn't investment knowledge on the trustee board, you need to make sure you're taking advice from an authorised person. Even if there is investment knowledge on the board, it's still regarded that you need to take advice from an authorised person. You also need to make sure you prepare a statement of investment principles, and this governs and sets out your investment strategy as a pension scheme. In particular, documents what your policies are, what your investment objectives are, which we'll look at in a minute, and also at the actual specifics of the strategy. That will be covered in more detail on the session on Wednesday. However, it's worth mentioning that investment regulations released in 2018 and 2019 have beefed up the requirements for statement of investment principles over recent years. In particular, the statement of investment principles now needs to disclose what your trustees' policies are with regards to environmental, social and governance issues. So it's being aware of the latest regulations with regards to that. In terms of actual investing the assets, the law and regulations reinforces the requirement of trustees to invest in the members' best interests to ensure their security, quality, profitability and liquidity, and also trading on regulated markets as well. So it'd be very difficult for a pension scheme to be investing in unregulated car park investments in Cape Verde, for example. But all of these effectively reinforce the duties of trustees when setting their investment strategy. And finally, pensions law and regulations restrict any self-investment. So this is investment where you are invested in any assets owned or directly controlled by the sponsoring employer to less than 5% of your scheme's assets. That can also include property as well, where you own the property but lease it or rent it to the sponsoring employer. This is particularly important for any pension schemes where your sponsoring employer is traded on a public stock exchange. So you may have inadvertently invested in the equities of your sponsoring employer, and it's just being aware of the level of exposure that you have to that. So we've looked at the pensions regulations and the laws and the duties that trustees now need to consider. So now we're going to set the high-level investment objectives. So what are the key things that we need to consider when doing this? First of all, we need to look at the sponsor covenant and how strong the sponsor is in terms of if there was an adverse impact on our funding, would the sponsor be there to stand by and fill up any funding deficit that appeared? What measure of funding do we want to target? So different funding measures might give rise to different investment strategies. We also need to consider what is our capacity and appetite to take on risk, and that applies equally to trustees and the sponsor. Also, we need to consider what return do we need to make sure that the value we place on our liabilities can be realistically supported in the future. And also finally, we need to consider, are there any objectives not covered? So for example, any long-term de-risking considerations or cash flow matching arrangements. So we'll discuss these in more detail in the next couple of slides. So the first one is sponsor covenant. And this ultimately is if the funding position of the scheme deteriorates, can we rely on our sponsor to provide the support we need to bring the funding position back up? And this is important in terms of how much risk we might be willing to take. So for example, a scheme that's got a deficit where it needs extra contributions from the sponsor, it's important for the trustees to consider how strong that sponsor is in practice. If it's weak and there's a realistic chance that maybe the sponsor is going to have financial difficulties or could become insolvent, we may have to consider investment strategy that doesn't take on too much risk so that any benefits accrued and covered by the assets are protected. Similarly, if we have a sponsor that's strong in financial terms and there is a funding deficit, then perhaps we can take on a bit more risk and the sponsor is willing to sort of take any adverse impact on funding as a result. The opposite side of that is if the scheme is quite fully funded, we might have a different conclusion altogether, i.e. the trustees may say, regardless of whether the sponsor is strong or not, the funding position is quite strong of the scheme and therefore we don't really need to take on the risk. So this just emphasises why considering your funding position is important and how the sponsor covenant or the strength of your sponsors works together in setting the investment strategy. And in particular, we need to consider what type of funding measure is important for our investment strategy. So typically, most pension schemes will set their investment strategy with regards to what's called the statutory funding objective or the ongoing valuation of your pension scheme or the technical provisions of your pension scheme. And in particular, this is important because it determines what funding is disclosed in terms of statutory disclosures and also what contributions are ultimately paid by the sponsor once that's been negotiated between the trustees and the sponsor. And in particular, that's come into some focus over the last couple of years where the pensions regulator has recently consulted on trustees to say, okay, you've got an investment strategy that will hopefully get you back up to full funding on your statutory funding objective. Trustees that will then need to disclose how they're going to take the investment strategy and the funding position of the scheme in the future, so beyond full funding on statutory funding objectives, to the point where we might be self-sufficient or have little reliance on our sponsor to pay anything further into the pension scheme. This is becoming particularly important for lots of pension schemes over the last couple of years. So lots of pension schemes are now looking at de-risking. So whether they want to target self-sufficiency or whether they actually want to target, say, a buyout with insurance companies. So the insurance company takes on the liabilities of the scheme and completely de-risk the scheme at that point. The strategies of those different options could be completely different from the strategy that we might come up with had we been looking solely at the statutory funding objective. Similarly, we also might need to have some regards to the accounting basis of what the value of the pension scheme that is disclosed in the sponsoring employer's books and balance sheets. Again, that might give rise to completely different investment strategy. So trustees need to decide which funding measure is important, and that will help guide the strategy that we're going to set. It's also perfectly acceptable for trustees to say we wish to target statutory funding objective in the first instance, but then consider self-sufficiency as a secondary funding objective. So it's just being aware of those options and what the implications on your investment strategy would be. Next aspect is risk and capacity and return. So we'll look at risk first. Trustees need to be aware of the difference between the capacity to accept a risk and the appetite to accept a risk, and they're not one and the same thing. And in particular, this is important because it will help guide trustees in terms of what level of risk mitigation should be inherent within our investment strategy. So the capacity to accept a risk is literally how much risk the scheme could take on, allowing for the sponsor covenant, assuming everything works as expected. However, just because we have the capacity to take on risk, we might not necessarily have the appetite to take that risk on. So again, it's worth bearing in mind the sponsor's views as well. They might have a different capacity and appetite to the trustees, and that will guide the investment strategy that we're going to target. The other side of this is the level of investment return that we need from our investment strategy, and in particular, when the trustees have set their funding plan, which places a value on the pension scheme's liabilities, a level of return will be implied or built within that funding plan. We need to make sure that the investment strategy that we ultimately pick will support that rather than invalidate it. We should also be aware of any sort of secondary objectives, i.e., for example, if we have a desire to get to buyout, we need to be aware of what level of investment return could be needed to get to that position, over what time frame, and whether that's an acceptable time frame, or whether it's better to take a long, slow and steady approach, taking less risk, but therefore having less return generated as a result. And finally, it's worth bearing in mind any long-term objectives of your scheme. And in particular, this comes down to, as we mentioned, the ability and the willingness of trustees to consider, should we be de-risking our investment strategy as the funding of the scheme improves over time, which builds on the long-term funding objectives consultation by the pensions regulator recently, i.e. demonstrating that once you reach full funding on the statutory funding objective measure, what are the next steps and how will you de-risk the strategy over time to make sure that members' benefits that have been accrued are protected in a worst case scenario. The other aspect, you consider the time frame for achieving those long-term objectives. So for example, we may have a certain year that we need to target, or it may be a bit more flexible depending on how the funding position improves over time. But this ultimately guides how much growth we might need. One other aspect that's come out in sort of recent years is also cash flow requirements. So a lot of pension schemes are now starting to turn what's called cash flow negative. This is where the contributions received from the sponsoring employer no longer meet the pension benefits that are paid from the scheme, if at all, and therefore ultimately the scheme's assets have to be disinvested. There is a way of setting investment strategies such that it generates natural investment income through bond interest or equity dividends, and this can help make sure that we're generating sufficient income to meet our outgo requirements over time. but it's given rise to what's called cash flow driven investment. So having regards to your cash flow requirements over the long term and whether you're doing things in an efficient way rather than, say, selling your assets when markets are depressed and therefore crystallizing any losses that have happened at that time. Your scheme actuary annual investment consultant can assist with long-term investment objectives and funding objectives in terms of modelling the work. So it's important to consider assistance from both those parties if this is something the trustees are keen to explore. So putting that all together, we then come up with our set of investment objectives. There's no right or wrong answer in setting investment objectives. They can be as wide or detailed as you like. We put a list of example objectives that schemes may wish to consider and which we typically see across schemes. So effectively reinforcing trustees' duties to meet the liabilities as they fall due, having regards to sort of liquidity of your investments, and making sure that the investment strategy meets the investment return that we need, disclosing any sort of risk exposures, and also considering whether we've got any desire to de-risk over time. So that's setting the high-level investment objectives. We now look at the risk and return of our investment strategy, and in particular, what trade-offs we should consider. So typically, we split asset classes into two buckets. The first one is what we call growth assets. So these are asset classes where they typically generate sort of long-term growth, net of inflation of about 5 to 10% per annum, so effectively real returns over the long term. But with this comes an expectation that those returns will have high levels of volatility. So they could have significant drops on a daily, monthly, annual basis, and also significant increases over the same period. They also carry with them other risks. So the main risk to consider is the risk of default. So equity is a good example of a growth asset in this instance. So if you recall that equity returns can suffer significant drops and rebounds over a short period of time, and the equities themselves can actually default, for example, and therefore be worthless. So there are different risks associated with growth assets. On the other side of that is what we call protection or hedging assets. So these assets are relatively secure, typically through bonds issued by governments or companies, and the default risk is lower, and therefore we would expect a lower return compared to growth assets. The hedging assets or protection assets also have the added feature of generating cash flows, and that can be useful, as we've mentioned earlier, if our scheme is cash flow negative, we actually need the income to pay benefits as they fall due. As we'll see later on, these protection assets can also be used as the basis to value liabilities, and therefore it's important to consider how we are valuing our pension scheme liabilities to determine what type of protection assets we might use in practice. It's possible that we'll need to see a sort of combination of those two asset classes unless, for example, the scheme was very well funded, in which case the trustees might take the view there's no appetite to take on any growth assets and the risks associated with that, and therefore the scheme could be solely invested in protection assets. But for a scheme that's got a funding deficit or a scheme that's broadly fully funded, it's quite common to see a combination of both types of asset classes. So we'll now consider what type of examples falls into each of those two categories. So we start with growth assets. So as mentioned, equities is historically been the primary growth asset, but as we saw in the last 12 months, equity markets can have significant drawdowns. So the impact of COVID-19 saw about 20 to 25% drop within 1 month, and that's given rise to, in sort of last decade, what's referred to as diversified growth funds or multi-asset funds or absolute return funds, and these funds are trying to deliver a steady, stable return with an element of capital preservation, so avoiding the sharp drawdowns of equity markets over time. And the theory goes that by avoiding those sharp drawdowns, you then have less to catch up, and therefore have to work a bit less hard to generate the same type of return over the very long term. Other asset classes we typically regard as growth assets are property. So this, for most pension schemes, will be UK commercial property. It will not be residential. So think about offices and industrial warehouses. Other types are what we call high yield bonds. So these are bonds where there's a higher risk of default from the company issuing that bond. Emerging market debt is another one, and these are typically bonds issued by governments or companies in emerging market countries. Again, the risk of default is high relative to, say, the UK or the US. Commodities, so oil and gold have historically been seen as the traditional commodities used by pension schemes over the years, but that's now starting to sort of move into other esoteric commodities such as nickel, for example, and that might be important if you're a strong believer that the rise in electric vehicles is sustainable, and therefore the nickel market will be supported by that drive in demand. And finally, private equity markets. So these are equities not listed on publicly traded stock exchanges, so not companies who are listed on, say, the FTSE stock exchange in London or the Dow Jones in the US. These are equities traded off those markets. But because, again, there's a high risk of default, we would expect a higher level of investment return in compensation for that. Other types of growth assets that come into play in recent years include infrastructure, so the building of airports, toll roads, schools, for example, and also forestry. So all of these asset classes have a common theme, which is they expect to deliver a strong investment return over the very long term, net of inflation, but with it comes a high degree of volatility within the returns and some other risks, primarily default risk, i.e. the risk that the asset could be worthless in a worst case scenario. On the other side of the equation is protection assets or hedging assets. So as mentioned earlier, government bonds, or in the UK they're called gilts, would be the ultimate safe haven asset class. As long as you assume that the UK government will never default on a government bond that is issued. We also might have corporate bonds, where the issuing company is high quality or has a very high credit rating, and therefore it's assumed that they will pay all the interest on time and not default on any interest payments. This has also given risk, has also come about in terms of buy and maintain corporate bonds over recent years. So historically, investment managers and funds might be holding corporate bonds for trading them underneath in terms of the actual individual bonds. So buy and maintain corporate bonds is a concept where you buy the bond and just hold it to maturity. As long as they don't default, you should get the interest payments that have been promised at the outset. We'll cover liability-driven investments in a minute. The other two protection assets are annuities, so these are effectively insurance company assets, and that's associated with a buyout or buy-in of the pension scheme, which is the ultimate de-risking of the pension scheme and cash. Liability-driven investment is a type of protection asset, so it has some of the features of the others, which is that that sort of link towards the bond markets in terms of the security side of things and tracking liabilities, which we'll see later on. But the one aspect of liability-driven that's not common with the other aspects is the ability to generate cash flow, and that might be important if your scheme is cash flow negative. So, for example, if you do need cash, you might need to consider some other protection assets in addition to liability-driven investment in order to generate that. But the key theme in all of these protection assets is the lower level of risk associated with these types of asset classes, and therefore we would expect a lower level of return. So you see instantly there's a trade-off between the two, i.e. we need to consider what level of risk and what level of return in combination is appropriate for our particular pension scheme. We should also consider how those different asset classes actually interact with each other, and that's particularly important for pension schemes. So, for example, we don't want necessarily, if this is a trustee's view, that our investment strategy and all the asset classes that we use move in the same direction over all time periods. So, for example, if a perfect storm happened and equity markets sold off, and we had a situation where we were solely invested in growth assets, the funding position of the scheme could drop down significantly, placing an additional funding pressure on the sponsor at a time when it can't afford it. So we need to be aware of how the different asset classes interact with each other, and this gives rise to what's the concept of correlation. So if asset classes are highly correlated or have positive correlation, they tend to move in line with each other over time. If an asset class has low or negative correlation, they tend to move in opposite directions over time. And if asset classes have zero or uncorrelated, there's no link whatsoever and tends to have some random pattern. This is important, particularly because of the relationship between equities and bonds have historically been used as a proxy for sort of how pension scheme liabilities have worked or valued over time. And in particular, the relationship between equities and bonds has historically had low or negative correlation, but that relationship hasn't always been maintained in the past. So for example, if equities and bonds suddenly become positively correlated, we could have a situation where our liabilities and our assets are moving in correlation with each other, which could have an impact on our funding position. So we just need to be aware of, as trustees, the level of correlation that can occur in practice. So if we have a look at some real life examples, so this slide shows 12 years worth of historic data, live data, and the correlation between different asset classes. So some of the things to draw out from this slide, first of all, you'll see in terms of the correlation between UK and overseas equities is quite high. So 1 would be perfect correlation in this instance. And you'll see that, as expected, the UK equity market does tend to move in line with overseas equity markets. It's not perfectly correlated for some features of the UK equity market, for example, quite high concentration in oil and gas companies, for example, but there's a strong correlation associated with the various equity markets. Second feature to note is property. So earlier we considered that property might be a growth asset class, yet we can see that property has very little correlation with both equity markets and government bonds, which might be a bit unusual. If we think that property markets move in line with equity markets, that's not necessarily coming through in what we've seen historically. And the final feature is also looking at how fixed interest gilts, so these are UK government bonds, how they are correlated with certain asset classes. And in particular, if we take fixed interest gilts as a proxy for pension scheme liabilities, you can see that historically over the last decade or so, pension scheme liabilities and the direction and travel that they've moved have been broadly uncorrelated with how asset classes have moved. And therefore that gives rise to the question of, should we have some regard and setting our assets that have some link with the liabilities to make sure that our pension scheme and our funding position is at least protected if, for example, the liabilities increases. For example, if we had UK equities, the chart suggests that UK equities might not necessarily respond at the time when our pension scheme liabilities are increasing in value. So correlation is important, and being aware of how these asset classes have interacted with each other over time and how they might interact in the future. So let's see how correlation actually works in practice. So in this example, we have two portfolios. On the left-hand side, you'll see a 100% bond portfolio, which delivers about 3% per annum return and has volatility or risk in this instance of 6% per annum. And on the right-hand side, we have an equity portfolio, which delivers an expected investment return of 7% per annum, but has higher volatility of return, so about 17%, as you would expect from historical data. So what happens if we set up a portfolio that was 50-50 split? We might naturally assume that the investment return is halfway between the two, which is 5%. And simply we might expect the volatility of our returns to also be an average of the two portfolios. But the problem with this example is it paid no attention as to how bonds and equities are correlated or how they are interacting with each other in practice. And then when we factor that in particular, if we assume a very strong negative correlation between equities and bonds, i.e. if equity markets go up, bond markets go down, and vice versa, we actually see something unusual, which is that the risk is not necessarily halfway between the two portfolios. So putting that all together, we have a situation where doing a 50-50 portfolio delivers us half the investment return, but not necessarily half the risk. And this concept brings out the concept of diversification, i.e. diversification can lead to better outcomes in terms of the volatility of returns that we might see through our portfolio, just allowing for the correlation that's happening within the asset classes. And it's important to note that diversification is a lot wider and can apply wider. So for example, in equities, for example, we might want to achieve diversification within certain equity markets. I'm not solely investing in UK equities. We might want to go overseas to have some certain impact of diversification that comes with that. Similarly, this example only considers two asset classes. The concept of diversification could be expanded to include multiple asset classes. However, your investment consultant can work with you to understand what's the impact of diversification within portfolios if you're introducing new asset classes or taking things away as you're starting to de-risk. So we've looked at asset risks and return, and now as we look at sort of understanding the liabilities, and as we saw earlier, having asset classes that are quite correlated to the pension scheme liabilities can be useful in setting our investment strategy if we want to make sure that our funding position has a certain degree of protection depending on whether liabilities move up or down. So first of all, we look at the concept of marking to market. So anyone who was attending the session last week will have seen that we could come up with a portfolio of bonds that provides a perfect match to our liability cash flow needs over time, and therefore the interest rate or the yield on that portfolio of government bonds could be used to effectively place a value on the liabilities of our pension scheme. The way of doing that in terms of having regards to the yield or interest rate on a portfolio of government bonds, or gilts in the UK context, is primarily used to determine pension schemes' technical provisions or ongoing liabilities under the statutory funding objective. However, as mentioned earlier, if we're trying to target a different funding measure, so for example, self-sufficiency or buyout, that might give rise to different types of asset classes. And in particular, the liabilities placed on a pension scheme under a sort of self-sufficiency type measure or buyout measure may have regards to portfolio of both government bonds and corporate bonds, and therefore we might come up with a different interest rate. Similarly, if we were looking at the accounting funding measure and placed high reliance on that, accounting liabilities are typically determined with regards to a portfolio of corporate bonds only, so no government bonds. This is important because from a trustee perspective, if you also happen to be involved in the sponsoring employer side of things, it's not necessarily a given that technical provisions and the liability value from that moves in perfect alignment with your accounting liabilities. And that's been particularly evident over the last year, where corporate bond markets and government bond markets have not been moving in parallel, and therefore a funding position on a technical provisions basis may have improved over the last 12 months, but the scheme's funding position on an accounting basis may have deteriorated over the last 12 months. So it's being aware that of these differences and the strategies that are applied depending on which funding measure is most important to the trustees. So just to re-emphasize this, the liability measures that we typically use in pension schemes are driven by bond prices, and therefore if we can come up with a portfolio of bonds and the price of that portfolio of bonds goes up, it would automatically lead to a higher value placed on our liabilities and vice versa. And that's certainly been the case over the last several years of the constant increase in bond prices. So that suggests that maybe we should be solely invested in protection or hedging assets if we want full protection against what the liabilities are doing on the other side of the balance sheet within the pension scheme. But as we saw earlier, protection assets or hedging assets don't necessarily deliver us a strong return, and we may need that return in order to support the funding plan or the discount rate that's being used in setting and placing value of your liabilities. One other aspect as well to consider is how your liabilities are sensitive to certain financial parameters. And then the main ones to consider is how they change to what's called long-term interest rates. And in particular, these are the yields on government bonds or UK gilts. This is not the interest rate set by the Bank of England, nor any interest rate set by commercial banks. And the other metric is also inflation expectations. So what the markets are expecting in the future from inflation. And this is typically a retail price index of inflation. The sensitivity to these two metrics are often called duration, but in simple terms, if we have a liability of our scheme with a duration of 20 years, that's effectively saying that on average, the liabilities will fall due in 20 years' time, and that average is a weighted cash flow average across all the benefit payments due over the lifetime of the scheme. So for example, the scheme's cash flow requirements could go beyond 20 years, but it's probably going to be of a smaller magnitude and therefore impact the overall average to a lesser extent. However, that gives an indication as to how sensitive the liability value is to changes in the financial metrics, and particularly interest rates and inflation expectations. So we've considered asset risks and return, we've considered what our liabilities are doing on the other side, and now we need to put that all together and also consider some of the investment risks inherent within a potential strategy, and whether those risks we're willing to take on in terms of allowing for an extra return that comes through. So it's important to consider risks in terms of, do we as trustees think we're going to be rewarded or unrewarded for taking that risk on? So rewarded risks effectively allows for an expectation that we will have a higher return over the long term to compensate us for taking that risk on. Whereas an unrewarded risk does not have that compensation necessarily, or maybe it's a bit uncertain that we will actually be compensated over the long term. It's also worth bearing in mind that typically when we go through these risks with trustee boards and pension schemes, it's quite common to see risk in a negative light in terms of the downside impact on our pension scheme. Those risks can have an upside as well as a downside. So it's worth bearing in mind, by taking on a risk, there might be an expectation that you're going to get compensated and then be rewarded for having the upside exposure associated with that risk. So if we look at the two types of risks separately, so on the left-hand side, you see rewarded risks. So the first one is growth asset volatility risk. In particular, this is associated with risks for investing in growth assets that we saw earlier. So typically equities, it might be property, multi-asset funds, diversified growth funds, infrastructure, for example. But it comes down to the concept that if you're investing in those asset classes and you're invested over the long term, so this is over a full market cycle, you as an investor are hoping to get a return that's commensurate with maybe the volatility of returns that comes with investing through that asset class. Another type of rewarded risk is default risk, and again, this might impact equity markets, for example. We as investors acknowledge that equities may have a default risk and we may lose the value of our capital, and therefore we expect a higher return to compensate us for the risk of that situation happening. In practice, default risk could be minimized by investing in numerous equities, not just one equity in isolation. Similarly, the asset manager who's managing your portfolio of assets could be managing this in the background and have that decision or delegation to minimize default risk in the background. The final rewarded risk is liquidity risk. So if you think as a retail investor If you went to the bank and asked for an ISA, an instant access ISA, the interest rate is probably not going to be great at the moment. However, if you went to the same bank and said, I want a 5-year fixed ISA, I will lock my capital away for 5 years, they're more likely to be offering you a better interest rate as a result. And it's the same concept of liquidity risk for pension schemes. If pension schemes lock away their capital for a long period of time, then it's reasonable to expect a higher return for not having the option to call on that assets in the future. It's worth stressing, however, that one of the trustees' duties in setting investment strategy is to consider what our liquidity needs are, and that comes back to earlier about your trustee duties, to consider how liquid your asset classes that you use within the pension scheme are if you ever needed to call on those assets for some unforeseen event. For example, if there was a sponsor insolvency or a big transfer out of a pension scheme benefit. The liquidity can be managed. So, for example, we might hold 10% in illiquid assets and 90% in liquid assets. So there may be some scope to have some liquidity risk within our investment strategy that's manageable and that we can work around, but also give us an enhanced expected return to compensate us for that. The unrewarded risks on the right-hand side. So the first two are important because they relate to how our liabilities move in practice. And these are the risks that the liabilities move in response to changes in interest rates or government bond yields and inflation expectations, which is not necessarily compensated by any changes in our asset classes or the asset value as a result. The concept of these two risks about not being rewarded comes down to, do we as trustees have full confidence that if we take that risk on, we're going to be compensated for it over the long term? And that comes down to whether trustee boards can predict the future path of interest rates with a high degree of certainty. And I'd be very surprised if anyone had full confidence in the future direction of interest rates in the next couple of years, given that interest rates seem to have gone in one direction, which was down in the last several years, and they could go in any direction over the next year, for example. Other unrewarded risks are longevity risk. So this is effectively your pension scheme members living a bit longer than you previously estimated, and the scheme actuary will make an estimate of how long members are expected to live and update it every 3 years. Concentration risk, so the risk of having a concentrated portfolio of assets, and the manager risk is effectively the risk of the investment manager not performing as expected, which will be covered on this session on Wednesday. The final unrewarded risk considered here is currency risk, and this comes down to historical analysis that currency markets and the relationship between certain currencies tend to even out over the very long terms. We're talking 10 to 20 years worth at least in terms of the relevant currency movements. If you hedged against movements in sterling, you may end up being in the same position in 20 years' time had you not done that. The only sort of key exception to this in recent times has been the impact of Brexit, where there was a material shift in exchange rates. But even then, we're starting to see some of the depreciation in sterling that we saw in 2016 now starting to unwind in the first few months of 2021 following the Brexit trade deal. So it just shows that whilst one position was beneficial in 2016, it may not have been beneficial this year so far. So looking at all those risks together from the historical experience that we deal with in terms of the pension scheme clients that we advise on, is typically growth asset volatility risk, interest rate risk, and inflation risk that have the most importance with regards to the impact on pension scheme funding. In particular, growth asset volatility risk will typically impact the assets of a pension scheme, whereas interest rate risk and inflation risk can impact both assets and liabilities of a pension scheme. So the risks that we have considered not in that list on the previous slide are equally as important, but they tend to have less of an impact. So typically we see sort of trustees focusing on these first 3 levels of risk when setting their investment strategy, and then having a sort of consideration of other risks once all of those the growth assets, volatility, interest rate risk, and inflation risk are sort of fully mitigated. We have a look at more detail as growth asset volatility risk. So this risk measure is typically regarded to the risk associated with developed equity markets. So if you had a portfolio of equities, you would expect your growth asset volatility risk associated with that portfolio to be about 100%. Multi-asset funds or diversified growth funds will typically have a growth asset volatility risk of about 50 to 2/3. And similarly, we might expect something of the same magnitude from property assets, although it's interesting to note that the growth asset volatility risk associated with property assets has been quite low of recent years, suggesting there's not much correlation as we saw earlier. But what that means in practical terms is we normally expect to see developed equity markets have some volatility of sort of 15 to 20% around their long-term average return over time. So in other words, if we had a expected investment return from equity markets at 10%, over a year period, we could see a drop of about 5% or an increase of 30% over that annual period and anything in between. So that gives you an idea as to sort of volatility that we might expect. And therefore, if the growth asset volatility risk is lower than 100%, then we wouldn't expect, we expect a lower level of volatility associated with those market movements. So putting that into an example, if we have our 10 million asset portfolio, which is a 50% growth asset volatility risk, and equity markets have a 20% fall, what that equates to in pounds and pence is about 1 million loss in this particular instance. But as mentioned, this measure of risk only impacts our assets, and so we need to consider the other 2 risks, which both impact assets and liabilities. And as mentioned before, the liability values can be impacted by changes in interest rates or government bond yields and future inflation expectations. Similarly, the sensitivity of the liabilities to those changes are equally as important. So in this particular example, we have a scheme where the duration or the interest rate sensitivity is 20 years. And that basically says if interest rates fall 0.1% per annum, then we might expect to see a 2% increase in our liabilities as a result. Those types of falls in interest rates are not uncommon, and in particular in early 2020, we saw significant drops in interest rates. So, for example, if we saw 0.5% fall in interest rates or government bond yields, we might expect our liabilities to increase by 10%. And many pension schemes did see significant movement in their liabilities in early 2020. And that works the other way. So in early 2021, interest rates have actually increased again by a significant move of about 0.5%, and that's resulted in a significant fall in pension scheme liability values. This also introduces the concept of hedging ratios. So for example, we could hedge part of that movement in our liability value rather than the full movement. So if our assets have some interest rate sensitivity or duration of 15 years, then the hedging ratio would be 15/20 or 75%. So in other words, the liability value movements would only be hedged for 75% of that movement in terms of the asset change. That can also work in a different way where we have assets that have interest rate sensitivity of 20 years, but we're only allocating 75% of the total assets of the schemes to those protection assets, and that will give us the same hedging ratio. Even if a scheme was fully funded and we had full hedging ratios, so the assets and liabilities perfectly moved in line with each other, we also need to be aware of funding deficits. So, for example, if a scheme is fully funded on the technical revisions basis, we may still have a funding deficit on a solvency or buyout basis. and therefore you can't necessarily achieve the same level of hedging protection on that particular funding measure. And that comes back to the earlier point about deciding which basis or which funding measure is important, as that will determine the investment strategy that we're going to set. So let's see a real life example of this in practice. So we've got our scheme with £10 million of assets and liabilities, and it's fully funded. And we're going to see a 1% fall in interest rates. The liabilities have an interest rate sensitivity or duration of 20 years, and therefore the 1% fall in interest rates results in a £2 million increase in your liabilities. If our assets had no hedging or protection assets whatsoever, that change in interest rates would result in a £2 million funding deficit, and the funding position of the scheme would fall from 100 to 83% in this instance. If we in turn had some protection assets that delivered about 75% protection against changes in interest rates, then the deficit arising from that scenario would be £500,000, so not 2 million, and the funding position would fall from 100% at the start to 96% in this instance. And then you can see on the right hand side, if we had our assets invested in a way that gave full protection, then the change in the liabilities would be perfectly matched by the change in the asset values. No funding deficit would arise, and the scheme would remain fully funded in this particular example. And this example can equally apply to changes in inflation expectations, and can also work the other way in terms of falls in liabilities and falls in assets. So it's being aware of the level of risk that you're taking with regards to the movements in assets and liabilities, and what impacts that may have on your funding position. So bringing this all together, one final point is about sort of taking a neutral position with regards to those key risks, in particular growth asset risk, interest rate risk, and inflation risk. The neutral position with regards to those risks is effectively fully removing or mitigating or hedging against that risk happening in practice. And as mentioned earlier, even if we have a fully funded pension scheme on a technical provisions basis and fully mitigated all of those risks, that does not necessarily translate into full mitigation on a higher liability measure or funding basis. So for example, buyout in this particular instance. The only way to fully remove all risks of three that we've considered is effectively to go to a buy-in policy or buy annuities, and that also gives additional protection against, say, for example, longevity risk. But it's being aware of the level of risk that you're taking. Anything that is not neutral, i.e. if you had a hedging level of less than 100% or not full mitigation, that's effectively expressing a view on behalf of the trustees on how that risk is going to behave in the future. So it's being aware of what positioning you're taking if you're not going to take a neutral position. So we've looked at all the high level details. We looked at the assets, risk and return characteristics. We looked at how the liabilities behaves. We looked at how certain risks are important if we need to take them on or if we're going to be rewarded. And all of these concepts now need to be brought together in terms of selecting an investment strategy and looking at potential alternatives. And some of the key risks that we considered earlier can be useful when comparing different investment strategies. So let's have a look in more detail at those risks. And in particular, we can look at something called stress tests, and these apply the risks in isolation. And they tend to be sort of standalone, so one risk at a time. The stress of that risk is not set in stone or prescribed anywhere, so the trustees can do different stress tests depending on what they're most interested in. So you'll see that in this particular instance, we've got the first one, which tests a significant drawdown in equity markets. This is looking at the impact of growth asset volatility risk on our pension scheme. The next one looks at changes in interest rates or government bond yields, and that's looking at interest rate risk. Third one is looking at changes in inflation expectations, so inflation risk. And the fourth one, it can be important if you're holding government bonds, where your liabilities are valued with reference to government bonds or government bond yields. And in particular, that gives rise to a risk that maybe our assets and liabilities are not perfectly aligned. These stress tests that we've considered here are standalone as mentioned. However, you can combine them into what's often called a sort of historic economic scenario or stress. That might, for example, look at the COVID impact in combination of how equity market movements happened and interest rates moved. We could also consider the global financial crisis of 2007 to 2009, or the impact of Black Wednesday in '92. There are a number of different combinations of stress tests that you can consider, and it's also worth mentioning that investment managers will also be doing these types of stress tests, particularly if they're running what's called a multi-asset portfolio, so a fund that invests in numerous asset classes. So if you are thinking about investing in those types of funds, it's worthwhile asking your investment manager, have you done these stress tests on your portfolio? How will it respond in a certain scenario? Where are the risks that maybe the portfolio doesn't give us the return that we need or we're expecting within our strategy? Another way of looking at stress tests, in particular how different risks work together, is what's called the value at risk. And in simple terms, the value at risk is often expressed either as a percentage or in pounds and pence. And this would be the funding deficit that would be expected at a very minimum over a certain time scale with a certain probability. And we'll have a look at an example at that in a minute. The value at risk measure can be backward looking, so we can look at how certain risks have interacted with each other over the past decade, for example, or we could do it forward looking and looking at sort of assuming how asset classes are correlated under certain economic scenarios. However, the key thing here is the value at risk provides trustee boards with a concept of risk that can allow investment strategies and different alternatives to be considered and provide some comparison. At the same time, it can also give an impact or an idea to trustee boards as to what level of funding contribution could be required in a perfect storm scenario. And if the sponsor can't meet the deficit that's implied by that value at risk, that suggests that maybe too much risk is being taken within the alternative strategy being considered. The value at risk concept or measure is also used by banks as well, so they will typically use this type of measure to stress their assets and make sure they've got enough capital adequacy to ensure the bank does not collapse in a perfect storm scenario. So let's have a look at this in practice. So the particular scheme we've got here had an initial funding deficit of 4.8 million, and we have considered a 1 year 95% value at risk, which is shown here in the red block of 5.9 million. So this, in other words, is saying that there's a 5% probability that our funding deficit will increase by 5.9 million or more over a given year in the future. The 5.9 million can be broken down into different components of risk, and here in this example we've considered inflation risk, interest rate risk, and growth asset volatility risk by the yellow bars. And the main one that jumps out is the middle yellow bar, the interest rate risk, where that's suggesting that maybe the particular investment strategy does not have full protection against changes in interest rates in terms of how our assets and liabilities are moving in practice. The green bar is allowing for all of those different risks to start to offset each other and start to diversify in practice. So in this particular instance, we're looking at historic value risk, and what we've seen is that interest rates and inflation expectations over, say, a decade have both moved down, and they're having different offsetting impacts in terms of their change in assets and liabilities. So they tended to diversify against each other. However, that green bar gives you an indication as to how much reliance there is on those risks offsetting each other in the future. And if the trustee board is not comfortable with that offsetting exposure and some reliance of that happening again in the future, then again it's suggesting that the level of risk within the alternative strategy is not appropriate. It's also interesting to note that the value at risk here is a 95% value at risk. So the value at risk figure 5.9 million is or more is occurring with 5% of the time, or 1 in 20 year event. It's interesting to note that that 1 in 20 year event is effectively comparable with both the global financial crisis and the impact of COVID. But I think we'll all be aware that the difference between those two events is not 20 years apart. So it's just bearing in mind what kind of historical data sets you're looking at as to the sort of impact of value at risk. One final aspect to consider when assessing alternative investment strategies is your expected returns. As mentioned earlier, we need to consider the return that's generated or expect to be generated from your investment strategy, and to make sure that it's supporting any funding assumptions used when placing a value on your pension scheme liabilities, and that will have been advised to you by your scheme actuary. Typically, there are two types of measures of assessing expected return. One is prudent or cautious, and this ultimately determines the interest rate or discount rate that's placed on your liabilities. And the other one is a best estimate expected return. So this can sometimes be the return assumed when there's, say, a recovery plan or deficit reduction contributions being assessed. It may be that the recovery plan uses exactly the same expected return when placing a value on the pension scheme liabilities, but it's not necessarily always the case. So just be aware of any differences in your funding assumptions and making sure that your strategy supports those funding assumptions. So putting that together in practice, we often go through some of the risk analysis and return analysis that you can see on the slide in front of you, and in particular having a look at different types of strategies. So in the example considered here, we can see that strategy A has a lower level of risk relative to the current strategy, and similarly strategy B has a lower level of risk compared to strategy A, and that's given by the value at risk and also the stress tests as well. But you can also see at the bottom on the last two rows that strategy B delivers lower investment returns, and if those lower investment returns can't support any funding assumptions that we've made when placing a value on the liabilities of our pension scheme, then that suggests that maybe strategy B is not appropriate in this instance. Maybe strategy A is the only option here. However, this type of analysis can help when considering different types of strategies in terms of their trustee objectives on risk and return. Some final points to consider. So as mentioned, have regards when you're considering investment strategies and picking ones about what's your long-term strategy. Do you want to have some sort of de-risking plan where you're taking the risk down over time as the scheme funding improves? So that might help pick a certain strategy such that it can be modified over time to deliver your long-term funding objectives. As mentioned earlier, again, have consideration for sort of cash flow or investment income generation. Do we need that income to meet the benefit outgo as it starts to arise, or is that need going to increase over time that we need to look at it in the future? Have some regard as well to any transaction costs incurred by moving between strategies, and also the investment management costs associated with any different strategies. And those two concepts will be considered in the session on Wednesday. And then the final slide is just to consider sort of next steps. So have some regards to your objectives, what you need from risk and return, consider what's the most appropriate strategy. Typically, then you would consult with your sponsor, again, check your rules to see if that's an explicit requirement, and then consider how you want to implement it in practice, and then transition. The last 4 bullet points will be considered in more detail in the training session on Wednesday. So I'm not proposed to sort of go through this in detail at the current time. And that concludes this session. So happy to answer any sort of final questions that you may have.
Thanks very much, Nick. Lots of information there. It's an involved process setting investment strategy, so lots of really good stuff for everyone to think about. No questions have come through, Nick. So given we're at sort of 10:12 now, I'd propose that we just wrap the session up. So thank you everyone for your time. I hope you found that informative and gives you sort of a base level of knowledge of what you might be looking at when you're setting investment strategy within your own schemes. Tomorrow we have a session changing tack completely. We're having a session on DC schemes tomorrow. So even if you're not a trustee of a DC scheme, it's probably highly likely that you have some benefits of your own in a DC scheme. So no doubt would be of interest anyway. So thank you again for attending, and hopefully see you tomorrow at 11 o'clock. Thank you very much.